What can stock prices tell us about the recovery from Covid-19? Well, the reaction of markets to the search for a vaccine may tell us something about the value of a cure. Viral, hello again.
Hi, Tim. Good to be back.
Now, when most economists are assessing the damage to the economy from Covid-19, they tend to look at things that are happening in the real economy, jobs, GDP, consumption, that sort of thing. Are you saying that they're missing something by not looking at asset prices?
Absolutely. And there are two important points here that I would like to convey, Tim. Firstly, let me be clear that I'm not saying real macroeconomic data are unimportant. They are absolutely key. They are what anchor our understanding of what's happening on the ground in terms of jobs, economic activity, etc. But they have one misfortune, especially the traditional statistical data, which is that they come with significant lags, sometimes several weeks, a month. In some countries, it could even be quarters. But in a situation such as a pandemic, it's very important to know really on an almost daily basis, if not a weekly basis, what's exactly happening on ground, because that helps shape your policy responses and so on. Now, there are better data that are being used by economists. Many of them have been deploying data from smartphones to construct mobility indicators. World Bank and the IMF have been using nightlight luminosity indicators in order to get the extent of economic activity. So there's clearly some progress on this front, but I would say markets potentially offer another avenue for real-time data. Markets are very often forward-looking expectations of cash flows of companies, their performance on their bonds, etc. And so in that sense, they are not just about what's realizing in the economy right now, they are also about expectations in future. But a second key point I would make is that very often we are not just interested in what is the level of economic activity, we are also interested in how uncertain the outcomes of the economy might be. Because uncertainty can be a big detriment to making investments. It can be a big detriment to spurring economic demand, because when uncertainty is high, corporates scale back on investments, households start getting into a hoarding mode, they become more precautionary in their behavior, and that could also be a significant impediment to recharging and restarting the economic engine. Markets value securities or their cash flows based on uncertainty associated with them. In particular, one of the basic tenets of modern financial theory is that securities whose cash flows are positively correlated with economic downturns, you would attach a very high risk premium to them. And we are quite interested in this aspect because we want to know how much the households are discounting being in a pandemic, how adverse a shock it is to their utility. How much are they discounting cash flows of securities because they think that the pandemic is generating cash flows which are also uncertain, and that uncertainty is correlated with their personal outcomes. And these kinds of signals you can almost never get out of the direct consumption or economic activity data. You have to use stock market prices or prices of debt securities in order to back out this risk premium that investors are attaching to economic uncertainty. So for both of these reasons, the timeliness as well as the price that we are attaching to uncertainty and the aversion that the markets have to it, we have to look at markets data in order to get at these issues.
But we often hear at the moment that this markets data, the financial sector, has become disconnected from the real economy. Do you disagree with that?
I wouldn't say I disagree with it. In fact, I'm quite concerned that there might be a lot of froth in several markets at present. Clearly, it's hard to justify the kind of prices at which Bitcoin is trading in the markets, for example. I also worry that several risks are probably not being priced as severely as they would, because the governments and the central banks have offered essentially a put option or a guarantee against these risks, at least for a short horizon. Nevertheless, markets data are useful in two dimensions. One, while there may be a time series component which is problematic because of this softening in the pricing of risk, it is still interesting to ask whether the markets are pricing the cross section correctly, which is, are riskier securities being priced more adversely than safer securities. By and large, this has been found to hold up well in the market, which is that the relative pricing of risk in the market seems correct, even if its absolute level is sometimes off. If I could just give one concrete example, in the lead up to the global financial crisis, everyone thought that the markets were very frothy and not discounting the risk of a downturn much. But even at that time, the riskiest broker dealers of the United States, such as Bear Stearns and Lehman Brothers, were being priced in the credit default swaps market at a higher credit spread compared to the safer broker dealers. And they were all, as a group, recognized to be riskier than the safer banks in the United States and so on. So, one, we have to sometimes pay attention to the relative signals the market is offering you. And the second point I would add there is that sometimes we are not interested in just the level of the prices, but how they are co-moving with some pieces of information. In our study, a very important piece of that that co-movement is with respect to the progress of the vaccine deployment. How close are we to deploying a vaccine? We have constructed a close to real-time indicator for vaccine progress. And we are interested in knowing how the stock market, both at the aggregate level as well as at the individual stock level, is co-moving with that vaccine progress indicator. And as long as that co-movement has not been fundamentally compromised by the policy responses, we can still glean some useful signals out of the stock market data.
Let's have a look at those movements over the past year, which, as you say, is the focus of your paper here. When we first knew about the economic damage of COVID-19, stock prices, well, I mean, they went off a cliff, didn't they? How much value was lost around that time?
You know, depending on the stock market that one talks about, we saw corrections of anything between 25% to 50% from the pre-COVID level. So say relative to 1st of January, we saw declines on the order of 25 to 50%. So let's say you take market capitalization on the order of, say, $50 trillion for an economy, we are talking about a loss of more than 10 to 15 trillion dollars of net worth of the economy at that point of time, just in terms of the stock market traded assets. Now, that is very large. In fact, now if you go to specific sectors, take hospitality, take entertainment that happens in person, take the travel sector, or take banks, which are exposed to the entire economy because they are lending to different sectors and therefore are exposed to whoever is exposed to the pandemic. Some of these sectors actually lost even more than 40 to 50% of their market value. So these corrections were absolutely massive. And the reason why they were so massive is because, in our view, we entered a new regime. We were functioning prior to 1st of January of 2020 as though we were in a pre-pandemic world and pandemics were not on the horizon. We didn't think that we were going to be shut down or in a lockdown mode in the very next year. We were virtually not attaching any probability to that event taking place. But then around mid-February, once the cases in Italy especially started spiking so much, cases in United States, UK, and other parts of Europe started picking up as well. We realized this is not just Wuhan in China. This is now a pandemic that's affecting the entire global economy. And we switched into the pandemic regime right around mid-February, explaining why the stock market correction was so massively severe at that point of time. And the second point I would stress here is that at the beginning of the pandemic, if we went by any records on the development of vaccines at the time of past epidemics, it used to take between 3 to 5 years for a vaccine to get developed and deployed. At the beginning of the COVID-19 pandemic, our expectations were in fact the same. We did not realize that that pharmaceutical companies, the biotech companies would be able to work at very fast speed. They would have platforms which are now leading to much faster development of vaccines, that the regulators and the governments all over the world would pump so much money into the development of the vaccine and create faster regulatory approvals without compromising on the product quality standards. And so, what I'm trying to say is that at the beginning of the pandemic, we could have been in this regime for quite some time because the vaccines would not have been discovered without the massive policy response that came into play.
So the story of that correction, that revaluation, was effectively that the global economy had fundamentally changed, and had fundamentally changed for what at that time anyone investing in it could see would be a period of years.
Absolutely. And I think if I can give a slightly, if I take a small diversion, which is that one of the interesting phenomena over the last year has been that ESG stocks, which are the stocks of companies that have high standards in terms of environmental sustainability, governance, etc., these stocks have suddenly found favor with investors. Now, why might that be? One reason could be that investors have realized that perhaps these rare disasters that we were thinking about as being truly, truly rare are no longer as rare. Second, even if they manifest with a rare probability, when they happen, now we have seen a real time playbook of how severe the impact of these kinds of disasters can be. And therefore, suddenly stocks which are going to be safe or immune to these kinds of shocks are now being valued in the market a lot. That is exactly the flip side of some of the sectors exposed to the pandemic crashing very massively by as much as 50% of their stock value from 1st of January.
Now, we are going to go later into a little bit more detail about how you've worked out the influence of news on vaccines on this. But even before we had news on vaccines, we had quite a lot of recovery in quite a lot of sectors. What's the story that was telling?
Certainly, if you look around 23rd of March of 2020 or 9th of April 2020, clearly the recovery on those days is all about what the Federal Reserve was doing for the global economy. The Federal Reserve said, listen, I'm going to offer my balance sheets not just to support the government bond markets, but I'll also support the corporate bond markets. Now, once that dollar liquidity enters the global economy, that's going to start looking for higher yields. It's going to find its way into emerging market assets. And so gradually they started recovering. Nevertheless, these were important shock and awe moments for policy regulators, and with attendant price corrections in the market, reversals back into positive or good shocks to the markets. But what you see is a continuously positive recovery over most of last year. And what we are finding is that that is very coincident with our vaccine progress indicator. There have been episodes of punctuated good news, both in terms of policy responses as well as the clinical trials of what have now been recognized as successful vaccine developments from BioNTech, Pfizer, Moderna, and in some other countries, there have also been local manufacturers that have now developed the vaccines. And there was a real compression in the time to deployment from what we thought was an average of 3 to 5 years. This was brought down with steady arrival of punctuated news all through last year, especially from May onwards. And in November, we essentially knew that the phase 3 trials for a couple of the candidates are going to be successful, and that in the first quarter of 2021, there's going to be global deployment of the vaccine. So this is now tremendous piece of good news. And our estimates suggest that for every year that we reduced in the time to deployment of the vaccine, the stock market was actually improving in terms of its returns by a whopping 4 to 8%. So now if you think about a reduction in the time to deployment, say by 4 years, from 5 years to 1 year remaining, you would have improved the stock market value by between 25 to 30%. Now that's massive. So what our estimates are indicating is that while it is certainly true that there has been policy support, and that is seen in the event studies around the Fed's announcements, co-movement of the stock market with the vaccine progress indicator can in principle explain a 25 to 30% of the recovery that has happened in the market as a whole.
Now, this vaccine progress indicator is at the heart of what you're doing in this paper. We've mentioned it a couple of times. You haven't really said how it's constructed. How do you make this?
Yeah, so of course, there's a lot that goes into it, and I recommend the audience to look at the details of the paper. But let me try and explain it in relatively simple terms. So, at the beginning of the pandemic, very soon, there were about over 200 candidates that were going to develop vaccines. Some of them were going to do it using one particular kind of platform for vaccine development, the so-called mRNA platform of Moderna, etc. Some others were going to do it using some of the more traditional methods for development of vaccines, etc. Now, as the vaccines develop, they have to go through several phases of trials. It's almost like within the pandemic regime, now there are different sub-regimes for the development of the vaccine. Initially, you are trying it on non-human subjects, then you try it on a handful of human beings, maybe just in tens, then you enter phase 2, and then you're doing hundreds, and then you enter phase 3, and then you are basically doing tens of thousands of trials, and then you have the true sort of control versus treatment, placebo versus the treatment kind of analysis that all drug approvals, especially of this nature and such critical nature, are subjected to by authorization regulators all over the world. So you are going through these sub-regimes, and historical data on the deployment of the vaccines in the past and their development in the past gives you indicators as to what is the likelihood of switching from one sub-regime of vaccine development to the next one. So for example, if you are in phase 1, what is the likelihood that you can switch to phase 2 with success? Because not all trials are successful. So it's not the case that every one out of these 200 plus vaccine trials is going to succeed to the next step. And of course, a priori, we had no idea that this was going to be Pfizer and Moderna. It could have been someone else, possibly, who reached this stage before. So the probabilities that can be estimated using historical data, implicitly, they are telling you how much time you are likely to spend in a particular phase of vaccine development. And it's almost like a first to switch, which is there are vaccine trials that will be successful and they will keep moving along the path of success, reducing the time to deployment as this happens. Now, that's one piece of news we use, which is basically just historical data. But of course, as I told you, this time has been different. The vaccines were being developed at a much faster pace. There's a lot of public money that got put into it, both for development as well as giving guarantees to the vaccine companies that their products will be purchased by the governments. And therefore, the level and speed at which the vaccines were developed has been much faster. And that different information this time is, of course, arriving through news. Because even though, let's say, you were likely to switch from phase 1 to phase 2 with a 50% likelihood, this time it was a lot faster, for example, and that would be evident in the success of the trials of Moderna and Pfizer, etc., during May and July of last year. So then what we do is, besides the traditional data that we used from the historical pandemics or epidemics, we were scraping the web all the time for real-time news data and updating our probabilities because we were moving faster this time. And, we have a procedure for using news to update our probabilities of success. Of course, sometimes there were also bad news because there were some adverse effects in case of some candidates, and those would reduce the probabilities. But essentially, you can come up with a simulation and therefore an estimate of how quickly you are likely to deploy the vaccine. And as good news kept arriving in our simulations, the time to deployment of the vaccine was getting shorter and shorter. In fact, if I can be very precise, when we first publicized our paper in end of October, the time to deployment was about 6 to 7 months. And that was almost coincident with Dr. Fauci's announcement that we are likely to deploy in April. But we ended up deploying them much faster in January itself. And so that was a further good news that arrived after we had released the first draft of our paper. But now, as we go along, we know that these things have to also be factored in to our vaccine progress indicator. So it's essentially using historical data, using news, and then using simulations in order to back out the time to deployment of the vaccine at a given point of time.
And interestingly, you have found that the signal from the co-movement of asset prices and your vaccine progress indicator has allowed you to put these quite definite limits around where you think asset prices are moving and the economic information that delivers.
Absolutely. In some sense, that is truly the core of the paper, of our research study. Even though the vaccine progress indicator is, of course, the most critical ingredient of what we are doing, what we are really after is that the stock market covariance or co-movement with this vaccine progress indicator firstly shows us that there is some component in stock valuations that's genuine information about how the vaccines are likely to improve the economic outcomes, reduce the uncertainty, and therefore move us out of this pandemic regime into back to a somewhat more normal regime, and how much therefore is the market valuing the development of the vaccines. Importantly, we find that it's not just the aggregate stock market that seems to behave in the manner I just described. You can also do a relative or a cross-sectional test. We know certain sectors like entertainment, hospitality, travel, banks were more exposed to the pandemic. And we do find that these are precisely the sectors where the co-movement with the vaccine progress indicator is more substantive than with others. In fact, to give you a very concrete example, in both May and July, in mid-May and mid-July, we had good news about Moderna. And you can look at on those days which stocks are actually moving the most. And of course, it's banks, it's cruises, it's airlines who are having massive, sometimes 10 to 20% moves on a single day. And unsurprisingly, FANGs, which are the sort of the high-tech sharing economy stocks, were not doing as well on those days because then, once you are out of the pandemic, the premium on e-commerce, etc., might not be as strong as it is during the pandemic regime.
The people who are making investments, who are reacting to the news that is captured in your indicator here, they are not epidemiologists. They don't really know how to evaluate that news. So therefore, are you sure that you are catching the value of a cure here, or are you catching sentiment about the wish for the value of the cure?
That's a great question. Tim, my sense is that to the extent that risks are perhaps not being priced as much as we thought they might be without the support of the governments and the Federal Reserve, that what we have found might even perhaps be a lower bound. So our estimate for the value that the investors and the society are attaching to the vaccine is 5 to 15% of the net worth. So let's say if we take the physical stock of assets to be around $50 trillion, our estimate suggests that the global economy as a whole, and if you think the US stock market is a representation of that because we have a lot of multinationals in the United States. So United States companies is not just revenues generated in United States, it's also revenues generated in the rest of the world. Then our estimate suggests that we are talking about something on the order of 5 to $12 trillion of value being attached by the global economy to the deployment of the vaccines. Now, what I want to stress is that this may only be a lower bound because perhaps while the risks are high, the pricing of the risks is likely muted because of the policy responses that have been put in place. Now, on the one hand, it seems like a very large number, but on the other hand, think about the economic carnage that we have seen on the ground. We have extremely high unemployment rates. We have contraction of economic activity. And of course, we don't know yet exactly when the economic activity will rebound, because even though the vaccines are getting deployed, now we are in the zone where we don't know how long the deployment regime is going to be. And when do we reach herd immunity of the level of 60% or 80% of the population being vaccinated fully? Just today morning, Dr. Fauci has indicated that we could actually be crossing 100 million doses, in fact, before President Biden's deadline, and that we could very well hit 80% sometime before the end of the year. Now, if that's true, then we would see a further possible acceleration in the valuations in the markets if that was indeed to be achieved. So the news is constantly arriving. Just because now we know vaccines are getting deployed, the relevant vaccine news has not ended. Now it's all about the speed of deployment, the easing out of the initial teething problems in the operations and logistics of the delivery. And there's something very interesting in the data that we have looked at historically from the London Center for Tropical Disease and Hygiene, which is that around week 10 to 12 of vaccine deployments, you see a very sharp ramp up in the number of doses that start getting delivered. I interpret it just based on common sense without having done any formal analysis that this must be because each time the operational logistics are more complicated, the bureaucracies figure them out how to solve them only when they have to solve them. But maybe in one quarter they figure that out and then we see a substantial ramp up.
Last thing, Viral, you did mention the constant interaction between policy responses and asset prices. Do you model these policy responses as part of what you're doing here, or is the point of your model the other way around, that it could inform policy responses?
I think it's more the latter, Tim. We take the policy responses as given in our theoretical model as well as its calibration. We are just sort of being somewhat cookie cutter in that sense. And the reason is because that would be very fascinating to do, but I think that's the natural next step of our formulation. If I could make three key points about what the study really delivers, it's a little bit like what Bob Lucas quantified in terms of how much would the economy be willing to pay in order to eliminate the risks of a recession. Similarly, now we are asking how much would the economy be willing to pay in order to eliminate the risks of pandemics. And that is basically switching out of a pandemic into the normal regime. So we have what I would say like a first step towards establishing that value. And importantly, we are doing it using data. We are doing it using a vaccine progress indicator. We are doing it using market prices and the covariance of these two. Second, and importantly, how much the economy values switching out of a pandemic is linked to how bad a pandemic is in terms of economic losses. Now, as you asked in your very first question, one way to estimate those losses is to wait for the real-time data to arrive. But another way our model suggests is to actually see how much is the covariance of the stock market with something like a vaccine progress indicator. Our model tells us very precisely how much should that be. And the most important driver of this in the model is the extent of economic loss in the pandemic regime relative to a non-pandemic regime. And so once we observe the covariance of the stock market with vaccine progress indicator, we can back out an implied estimate of the economic losses. That's on the order of 25 to 30% of loss of activity. And that's actually consistent with what the real-time data are showing. And third and the last point would be that our model also helps us understand how much the investors would value resolving uncertainty about this pandemic. Now, what do I mean by this? At the time the pandemic started, we were not sure how long would it last. What is the likelihood of arrival of the next pandemic once this pandemic is over, etc. And many have learned from this pandemic that perhaps SARS, H1N1, COVID-19, all occurring within 2 decades or 25 years, is perhaps something to worry about. Maybe the likelihood of arrival of pandemics is more frequent than what we had thought in the past. Now, this is an additional uncertainty that we face about what are the parameters driving the arrival of pandemics and their durations. And what our model shows is that this uncertainty about not knowing exactly what is the structure driving the pandemics is also something that causes great disutility to the investors. In fact, if you could eliminate that uncertainty, they would be willing to pay almost twice as much for the arrival of a vaccine than you would without that uncertainty. All in all, it suggests that rare disasters such as the pandemics or climate change induced disasters may be something that the investors will be deeply concerned about going forward. And we are offering relatively straightforward stock market based approach in order to value how much we should be willing to invest in order to reduce the risks of their arrival in future.
Well, when and if, I think it might be when the next pandemic comes along, one piece of information, historical information that we will have at that point is how good the vaccine response is to it. And we'll also have your model to be able to interpret it as well. So, Viral, thank you very much.
Thank you, Tim.
The paper's called The Value of a Cure, an Asset Pricing Perspective, and you can find it in COVID Economics 61, which you can download using the link on the screen now. Remember to keep up with all the latest research on COVID-19 in COVID Economics, and that's free, it's open access at CEPR.org.